Hey everybody, how are you? It is Tuesday morning, 11 p.m. Pacific time on January 9th, and we are going to discuss how the tax bill is affecting our local communities. There's a lot of hysteria, a lot of questions, a lot of misinformation, and here we are really live. So Kyle, would you mind telling them to shut that down a little bit? Sorry, so folks in the office are actually watching this webinar as it's happening, and the volume's just blaring into my office where I'm producing this now, so we're gonna have them lower the volume. But anyhow, there's the beauty of live broadcasting. We have a lot of misinformation, like I was saying, a lot of worry, a lot of panic, and some of it is warranted. There are some concerns. We're going to walk through them, but at the same time, there's also my goal on this webinar is for us to all show up at what's the real truth. How much should we be worried? How much should we be concerned? And also, are we disproportionately allocating? Are we disproportionately allocating worry or value to this tax bill as related to real estate, especially on the high profile items like the tax deduction, the local and state tax deduction. So I want to walk through them. Let's just jump right into it. We're going to discuss first the bullet points, what affects real estate most directly, but then I want to go through actual concrete examples and work through the math of what does it really mean in real life, okay? So for example, just jumping into it, the mortgage interest deduction is one of the key points that's going to affect real estate. The mortgage interest deduction was reduced from previously $1 million to now $750,000. Now, that doesn't mean that we're all going to have to pay, or folks at that price bracket are going to have to pay $250,000 more in taxes. What it means is that you have $250,000 less of mortgage payment, where the interest on that payment is no longer deductible. Okay? Now, we're going to walk through a concrete example, but I want to just walk you through a couple of other points around this. First of all, it's only affecting new mortgages. So it does not affect mortgages that were already grandfathered in, were already in place at the time that this bill went through. And you actually, something that a lot of people don't know, you can actually still refinance any debt you had existing on, any mortgage debt that you had existing on your property. So if you had a first mortgage on your property previous to December 14th of this past year, so if you had it already in place, a mortgage previous to December 14th, 2017, you actually can still refinance that loan and keep your grandfathered deduction. So that's a big point a lot of people aren't aware of. Secondly, it's that interest remains deductible on second homes. Okay, subject also to the same limits, but on second homes, we did maintain the interest deduction, which we thought might entirely go away. And here's the real way in which it's going to affect us, okay? The reality is that for neighborhoods where you have $1 million price points or lower, there's really going to be very little effect. And here's why. Let's suppose that you have $1 million, let's say here, let's do this. Keep in mind that the old was $1 million and the new is $750K. Okay, so you have a delta of $250,000. That's the maximum that anybody can be, let's just call it penalized. So the maximum effect that you could possibly feel is the deduction of the interest on $250,000. So if I grab my calculator and we assume a 4% interest rate on $250,000, and again, I'm not concerned with the principal payment because it's only the interest payment that would have been deductible. So previously, so that equals $10,000, okay? So under the old law, you would have had an additional $10,000 of deduction. But under the new law, $10,000 has gone away for you. But $10,000 isn't the tax that you would have had to pay, okay? That's the deduction. So what's the tax or what's the tax you would have paid on that $10,000. So if you're, say, let's just choose a tax bracket of 3,500, or excuse me, of 35%. If you're at a 35% profit, or excuse me, a 35% tax bracket, 35% tax bracket against that $10,000, that means that the biggest effect that the market can see, anybody can see, is roughly $3,500. That's assuming, okay, assuming a 4% rate. Again, because any loans previous to this law above $1 million, all of the interest above $1 million, you weren't deducting that anyway. Okay, you're not deducting that today, but you weren't deducting that previously. So there's no change above $1 million, and you can still deduct up to $750,000. So what that means is that $250,000 of mortgage interest, which the interest on $250,000 would be roughly $10,000, assuming a 4% rate, and the tax impact of not being able to deduct those $10,000 is $3,500. So, and we'll go deeper into this, but in general terms, if you have somebody with $1 million loan, which would be the maximum impact, okay, because they're the folks that are going to feel that $250,000, they're going to be out $3,500 a year that they weren't previously. Having said that, what will the effect be on the real estate market really? Because the question now to ask ourselves is how many folks that are buying homes in excess of $1 million, and I'm saying in excess of $1 million because to have $1 million loan, the purchase price is in excess of $1 million. In fact, if they're doing a 20% down payment, it would be a purchase price of $1.25 million. Okay, because $1.25 million, 80%, right, times 0.8 equals $1 million. So whoever buys a $1,250,000 house with the traditional 80% down or loan, so 20% down payment, is going to have a loan of $1 million, which is the maximum effect that somebody can feel, and it's going to cost them roughly a $3,500 impact on a yearly basis. The question to ask ourselves is how many folks that are buying homes for $1,250,000 are making life decisions on where they're going to live, where their family's going to be, what life is going to look like based on $3,500 a year. There are people in that bracket, there are people in that space that are, stretching into that $1,250,000 house, and now just becomes a little too uncomfortable based on those $3,500. And that is a reality. Those folks will exist, but it's not going to be the entire market. It's not going to be most people, because most people buying a $1,250,000 house aren't making life decisions on $3,500 a year. Okay, so that's a very big point that I want to make here, because we need to take the headline and just chunk it down to how does it really affect us in real life, okay, if that makes sense. Also, just going along with this topic of the interest deduction is you should know that the final bill that does repeal the deduction for interest paid on home equity lines all the way from now through 2025. So those are just not going to be deductible at all. And interest is still deductible, however, on a home equity line. Here's a loophole to that. Interest is deductible on a home equity line if the proceeds go to substantially improve the property. Now, how substantially is defined, we're going to have to find out. But if the proceeds go to substantially improve the property, then the interest is still deductible. But a lot of home equity lines are used for vacations or for cars or for debt or other issues, and that will no longer be deductible. Okay, but I just wanted to highlight this. Your maximum penalty, that's it, $250,000, or is on $250,000, the delta between the old law and the new law, which is really a $3,500 tax impact. Now, think about it this way. At $1 million purchase, which is roughly double the average price point in our marketplace, had $1 million purchase with a traditional down payment of 20%, you have an $800,000 loan. So with an $800,000 loan, you're only $50,000 above the threshold. So you only have $50,000 of loan through which the interest will not be deductible. So just to further illustrate the point of how this is not the biggest point in the tax bill, this is not the biggest impact. I'll share with you what I believe the biggest impact will be. But so many people are worried about the deductibility that I just want to share with you that if you have $1 million purchase, which means theoretically you have an $800,000 loan, right? Again, you can deduct the first $750K, so you'll deduct that. So 800, 750, only $50K is not deductible. The interest of $50K at 4%, if the interest rate is 4%, that's $2,000. Or excuse me, that's $2,000 deduction that you then, if you're at a 35% tax bracket, would suffer the loss of $700. That's it, okay? So even $1 million home buyer is roughly going to suffer a $700 loss a year. It's money, so I'm not saying it's insignificant, and I'm not telling you that I would want to lose that $700 a year. I wish we still had it, but it isn't going to drive the majority of the decision making in the public for that type of buyer. For $1 million buyers, $700 is just not moving the needle one way or the other on a typical basis. So what is the biggest deal about the new tax bill? Really, when you look at the state deduction limit that's now been brought down to $10,000, that's where I think you're going to see the biggest impact. And let's go ahead and walk through that, make sure we're defining it properly. And I will remind you, by the way, that in the chat roll, if you have any specific questions, go ahead and leave your questions there, because I'm going to also run Q&A here, and we're going to make sure we get all your personal questions answered, and we'll just workshop and brainstorm a lot of this. Keep in mind, I'm just starting to see this also, and we're living through this together, but I could give you my perspective, and we can also just talk about the market in general. So any market-based questions, real estate questions, or obviously tax questions, go ahead and leave them in the chat roll here and I'll answer them. So previously we were able to deduct our property taxes plus our state income taxes against federal. And the talk was that they were going to completely do away with that, but thankfully they still gave us something. They are still allowing us to deduct $10,000, but it's a combination of property plus state income tax. So in California, and specifically in higher price point markets like, say, the Del Sur's or the Forest Ranches, the Crosby's, Santa Luz, parts of Carlsbad, or even high Mello-Roos areas, especially like the areas we just mentioned, San Elijo Hills, Otay Ranch, Mello-Roos there. Most of us, most of us are going to well exceed the allowable $10,000 deduction. So what that means, and this is really where we could see big impact, okay? Because high income and luxury price points, a lot of those folks are already paying 13% bracket. They're on the 13% state bracket. And so if you take a look at an example of somebody making, again, I think this is going to be an impact at luxury price points. If someone's making $500K a year at a luxury price point for their home, right, and let's say that they own $500K a year income. Let's imagine that they own a $2 million house where the taxes here equal, let's just call it $20,000, but if they have Mello-Roos, it could equal as much as close to $30,000 a year on taxes. And if they're making an income of $500,000, they previously would have had a federal deduction of roughly $65,000, which if they're then paying federal at 35% or so, would have saved them $22,000, $23,000 a year, which is real money, okay? It's significant money. And now the interesting thing is, it's not that they can't afford to do it. It's not that they can't afford to still stay in that type of property and still buy the $2 million home. But keep in mind that these are folks that are already being taxed in excess of 6 figures a year. Okay, so when you're already being taxed in excess of 6 figures a year, you have tax fatigue. You're just sick of it. You're tired of it. Doesn't feel good. And imagine that's at 500K in earnings, right? At $1 million in earnings, now go ahead and double that. So you're talking about let me go back to the calculator here. You're talking about at $1 million times 0.13 for state, they typically would have had a $130,000 deduction that they no longer have. Plus, by the way, don't even forget about that 30K. So they would have also added $30,000 to that. They would have, so it's basically costing them $56,000. $1 million earner is paying roughly $56K more a year. Again, they could still afford it. They could still choose to stay, but there's fatigue. These are the folks that are trying to figure out ways to spend 181 days a year in Phoenix and call this a second home market instead of their primary, so that they could avoid state tax, especially now that they can't deduct. And this was already going on previously, but now that they can't deduct, it's even more so. And so it's that higher price point house with the higher price point earners that are most likely to see the biggest impact. Okay, that's where I think you're going to see impact, is when we start talking about $1.5 million, $2 million, $3 million price points around the county. I think that's where you're going to see escalating inventory. Now, interestingly, we were already seeing that escalating inventory going back to pre-election. And for whatever reason, after the election, the inventory started to diminish once again, even at the higher price points. But that's the most likely place where you're going to see that reverse course. And in fact, even the National Association of Realtors, who wants nothing more than to put out good news, right? That's what they do. I mean, they're a lobby. That's what they do. And they have an agenda and they're biased. But even they are admitting that they believe they'll see, now this is a national statistic, that they believe they'll see roughly a 10% impact on high price, high tax areas, such as many of our communities. Again, but it'll be high price, high tax areas. So the deadliest combination would be high price point with Mello-Roos, right? Because not only do you have the tax, but you have the additional Mello-Roos tax at high price point with high earners, and they're now being hit in excess of, say, $56,000 a year, literally out of their pocket, when they're already contributing 6 figures a year to taxes. Those are the folks that are most likely to see fatigue and effect and just annoyance, irritation from this new tax bill. And that's where you're most likely going to see inventory issues pop up. So some good news for you. They were also discussing taking the capital gains exemption, where on your personal residence you're able to currently, and it was previously, but they retained this, which is awesome. You were able to sell after living in your home for 2 out of the last 5 years. You were able to sell as a married couple with a $500,000 capital gains exemption, or as an individual, $250,000. That was retained, and they almost made it. It was like a last-second change. And so if you didn't know about the last-second change and you believe that was altered, I could tell you it wasn't. But what they almost did was they made it so you had to live in your home at 5 out of 8 years. I think that would have been a tremendous impact to the market, because we already have tight inventory here locally. And so when you already have tight inventory, and even take me for example, I'm considering selling my house, but I've only lived in it for 3 years. So if they would have passed that, there's no way I would have sold my house until I would have hit 5 years. So that would have delayed my house coming to market for 2 entire years. And now extrapolate that across all of the households in our marketplace, where there's already tight inventory and now they're hesitating to sell. That would have squeezed inventory further it would have actually caused some price gains, but it would have also just exacerbated the issue that we have around affordability. So thankfully that did not happen. Now the final bill does repeal, these are just more side notes, okay? The final bill does repeal the moving expense deduction. So previously we could deduct our moving expenses, no longer can. We'll see what the effect of that really is, especially, I think that's more something that would typically affect folks in lower price points with lower income. But we'll see if it is in effect at all, because at the same time the standard deduction was doubled. And so it may or may not come into play at all. It might just be a wash. Again, I don't think for $800,000, $1 million, $2 million buyers or sellers, I don't believe they're making any decisions around their moving expenses as far as the truck being deductible or not being deductible. So we shouldn't see too much effect from that. By the way, service members, you are exempt, so you still do get the deduction. And depreciation. Depreciation was retained in its current form. So commercial property, non-residential, you can deduct the real asset value, so not counting the dirt, but the building, you can deduct or you could depreciate, I should say, over the course of 39 years. Residential rental properties, you can depreciate them over the course of 27 and a half years. And here's what that looks like. And by the way, improvements you make to any rental properties, you can depreciate over 15 years. So for example, if you build a pool, it costs you $100,000, and you could deduct that $100,000 over the next 15 years off of your taxes. If you buy, for example, I just bought a home in a neighborhood in 92127 zip code called Westwood. It's an investment property, and I paid $704,000. The tax assessor's likely to call the structure value roughly $350,000. So I will be getting a $350,000 divided by 27.5. I'll be getting a roughly $12,700 deduction every year, which will give me a roughly $4,500 real dollar tax value, tax benefit on a yearly basis. Let me come over here to the questions. Can you talk about the benefits of paying the property tax in 2017? So you were able to pay your property taxes for 18, or at least the April installment, in 2017, but unfortunately that's gone. So if you paid it, what that's going to do is, remember, here, let me map this out for you. For those of you that did this, but you just kind of did it last minute and you weren't sure why or how you were doing it, and you want to make sure you document it correctly on your taxes, on your return coming up for this coming year, remember that you're limited now to $10,000 of deduction, which is made up of property plus state and local. Is that on the screen all the way, Kyle, all the way up here? Property, state, and local. So you're able to deduct only up to $10,000, but of property plus state and local income tax. Now if you have $1 million home, you've already eaten up the 10K. And if you have Mello-Roos on your property, you could have a home half that price and you've eaten up the 10K. So you're likely going to be affected by this. Now what they were allowing us to do, and they did allow us to do, is that if you wanted to pay your April 2018 property tax installment before the end of the year, if you went ahead and did that, what that means is that you're now, let's say you made a $5,000 tax payment, okay? So if you made a $5,000 tax payment before the end of the year for your 2018 taxes, that 5K won't go against that 10K. So essentially, you're going to have the 10K plus 5K. Okay, so if your state taxes are likely to exceed the $10,000 limit, the good news is that for this coming year, you're actually going to get a 15K deduction, but it's just for that 1 year. They're not allowing that to happen moving forward. Also, if some people went ahead and paid their 2018 predicted income taxes, trying to get that same benefit. If you did that, I don't have the answer for you. On paper, I could tell you that it's not stipulated as something that's necessarily allowed. Having said that, talking to a lot of CPAs, they're saying that they still suggested to some of their clients that they go ahead and do it because they believe that they're going to be able to make the argument that it should have been deductible. And so we'll find out how that goes. Keep in mind, I am not a CPA. I do not give tax advice. I'm just giving you my understanding of how the new tax bill is going to affect real estate. Again, we have some people running around town yelling about how the interest deduction is going to devastate us. Well, it's not, okay? I've just shown you how even $1 million buyer is going to have at most a $700 or so, depending on their interest rate. But if assuming a 4% interest rate, $1 million buyer with a 20% down payment, their pocketbook will be affected $700. $1,250,000 buyer will have the maximum impact to their pocketbook. That'll be roughly $3,500. And it's real money, but it's not necessarily how people make decisions in their life. The most immediate real impact that we're likely to see is around this issue, the $10,000 of state and local income tax plus your property tax. So anything in excess of the $10,000, you can no longer deduct against federal, as high income earners were always doing. They would get that all paid in December before the end of the year and deducted against federal. No longer available in excess of $10K. And for $500,000 earners, $1 million earners, you're talking about impacts in the range of $30,000 to $60,000 right out of their pocket, in addition to the other six-figure sums that they're already paying. You may see them scale back and say, you know what, enough is enough. I'm sick of California, or I'm sick of the big property. And so you might see a flight to smaller homes, which could even be a boom to say if you're in a Del Sur, a neighborhood like that, 800 million, $1.2 million type neighborhood, you might see some $2 million people, or some $2 million home property owners choose to scale back to say $1.2 million, $1.3 million, $1.4 million, and reduce the impact of what the government has now imposed on them. So I hope that is clear. I hope this has been helpful. If it is, then by all means, share this with people, because I'm going to send you the replay so that you could review it. If you know anyone that has questions around this, you can always forward them the link. And remember that we're at the Beer Home Team 100% available to you. We live here locally, we're in the community. You see us on a daily basis as far as the sales we're impacting around you and serving the community. And it's my pleasure and privilege to be a part of this wonderful community that we have here. So thanks for jumping on. I won't keep you long as promised, but I just wanted to hit the high points and make sure that we understand where the real impact is. The summary is that the real impact is in the state deduction, along with the property tax deduction being limited to $10K. The interest deduction is a much lesser issue. And so share that message with other folks. And remember, if you want permanent deductions, or at least long-term deductions, the best you can get is depreciation. That's why I just bought a property this past year. That's why I buy property on a yearly basis. If you want depreciation in your life, so you could have long-term deductions that are unlimited, which means you could at some point have income that's up here and not pay any taxes. Okay, that's how high-profile folks with high incomes and very small tax bills, they do it through depreciation. Talk to your CPA about putting a strategy together, and of course you can talk to the team about investments. I'll show you exactly where I'm investing, so that if it's a strategy that makes sense for you, you could follow suit. Till then, everybody, thanks so much. I'm Dan Beer, Beer Home Team, and you've been awesome. Thanks for joining us.